We now proceed to capital gains. First, we look at the chargeability. What is charged to tax under the head capital gain? Covered by section 45(1). So any profits or gains from what? From the transfer. Transfer of what? Of a capital asset. Transfer made when? Which is affected in the previous year, is taxable under the head capital gain unless exempted under section 54 to 54H. And this capital gain is deemed to be the income of which previous year in which the transfer took place. So capital gain is taxable in the year in which the transfer of capital asset took place. What is the meaning of capital asset? Relevant section is section 214. Let's look at this chart. Property A, B and C are capital asset and therefore their transfer is liable to tax under the head capital gain. A, property of any kind, so the scope is very wide, which is held by the SSE whether or not connected with his business or profession. But this excludes the following: 1, 2, 3, 4, and therefore transfer of these properties is not taxable as capital gain. 1. Stock in trade, consumable stores or raw materials held for the purposes of business or profession. Transfer is not taxable as capital gain. Number 2. Personal effects. Personal effects. What is a personal effect? Movable property, not immovable. Movable property, but it includes wearing apparel and furniture, which should be held for what purpose? For personal use. By whom? By not only the SSE but also any member of his family, provided such member is dependent on the SSE. But we need to note that personal effects excludes the following items and therefore these are capital asset and their transfer is taxable as capital gain. And what are these items? Jewelry, archaeological collections, drawings, paintings, sculpture or any work of art. And jewelry includes ornaments made of gold, silver, platinum or any other precious metal, as well as precious or semi-precious stones. So this is the acronym DAPSAJ, DAPSAJ within bracket OS, which you can use if you want for quick learning. Now third item, which is not a capital asset, is rural agricultural land in India. So land which is agricultural, which is in India and which is in a rural area. Transfer thereof is not taxable as capital gain. Fourth, gold deposit bonds issued under the Gold Deposit Scheme 1999 or deposit certificates issued under Gold Monetization Scheme 2015 is also not a capital asset. Now B, any securities held by a foreign institutional investor is a capital asset and transfer thereof is taxable as capital gain. C, ULIP, unit linked insurance plan, which is not exempt, that means it is taxable, not exempt under section 1010D. On what account? On account of it being a high premium ULIP is a capital asset and therefore capital gains applies. Now this is something which is outside the scope of CA intermediate syllabus, so we will not discuss the tax implications in case of a ULIP, but this is what you need to know, that it is a capital asset. So as we noted above, rural agricultural land in India is not a capital asset and transfer thereof is not taxable as capital gain. And what does this mean? This means agricultural land which is in India and which is situated outside urban area. Outside urban area means it is situated in a rural area. So the question is, what do we mean by urban area? It depends on the population of area. If the population is less than 10,000, then the area is not an urban area. If the population is 10,000, urban area means the area within the jurisdiction of municipality or cantonment board, MCB. Where the population is greater than 10,000 and up to 1 lakh, it means area within the jurisdiction of MCB plus up to 2 kilometers from the local limits of MCB measured aerially. Where population is greater than 1 lakh and up to 10 lakh, this 2 kilometers becomes 6 kilometers. Where the population is greater than 10 lakh, the 6 kilometers is further increased to 8 kilometers. So this is the meaning of urban area and consequently we can determine whether the land is in a rural area. And if the land is a rural agricultural land in India, then transfer thereof does not give rise to capital gain. So transfer of a capital asset is taxable as capital gain. So what all is included within the meaning of transfer? Section 247. there are 7 items to note. 1. Sale of capital asset, exchange of capital asset, or relinquishment of capital asset. Second, extinguishment of any rights in the capital asset. 3. Compulsory acquisition of capital asset under any law, and this is covered specially by section 45(5), which we will see in some time. 4. Conversion or treatment of capital asset as what? As a stock in trade of a business, and section 45(2) is relevant, which we will look at in some time. Maturity or redemption of a zero coupon bond is a transfer, and therefore capital gains arise. Sixth, transaction allowing possession of immovable property in part performance of a contract, which is referred to under section 53A of the Transfer of Property Act, is also covered within the scope of the term transfer. 7. Transaction which has the effect of transferring or enabling enjoyment of immovable property, and it can be by way of becoming member or acquiring shares in a cooperative society, company, or other AOP, or in any other manner. Types of capital asset and types of capital gain. So what we need to see is whether the capital asset is held by the SSE for more than the specified period immediately preceding what? The date of its transfer. A specified period is basically the cutoff in terms of the period of holding, and this is something that you can see in this table. So if the period of holding is more than this cutoff period, then the capital asset is classified as a long-term capital asset, and transfer thereof gives rise to long-term capital gain. Else, the capital asset is a short-term capital asset, transfer thereof gives rise to short-term capital gain. So what is the cutoff of the period of holding? And this is what is given in this table. So 1. Share of a company, and it can be equity shares or preference shares. Shares of a company depends on whether the share is listed in a recognized stock exchange in India. In that case, it is 12 months. If it is not listed in a recognized stock exchange in India, it is 24 months. For example, shares of a private limited company, which is an Indian company, or shares of a listed company, which is a foreign company. 24 months will be the period of holding cutoff. Second, in the case of unit, if the unit is of the Unit Trust of India, 12 months. Unit of an equity-oriented fund, 12 months. Unit of a debt-oriented fund, 36 months. Debt-oriented fund is a fund which is not a unit, which is not an equity-oriented fund. Third, zero coupon bond cutoff period of holding is 12 months. As far as other securities are concerned, that means not referred above in 1, 2, or 3, not share or unit or zero coupon bond. And what is the meaning of security? It includes shares, bonds, debentures, derivatives, government securities, rights or interest in securities, etc. So for example, this category 4 will include, say, debentures. So if these other securities are listed in a recognized stock exchange in India, then it is 12 months. Else, that means where it is not listed in a recognized stock exchange in India, it is 36 months. In the case of land or building or both, immovable property, it is 24 months, and in any other case of capital asset, it is 36 months, for example, in case of jewelry. Now we look at the mode of computation of capital gain. What is the formula? Relevant section is section 48. And the gain can either be short-term capital gain or long-term capital gain. We first figure out the full value of consideration. We deduct expenditure incurred wholly and exclusively in connection with the transfer. This gives us the amount of the net consideration. From that, we deduct cost of acquisition and cost of improvement. But in case of long-term capital gain, instead we deduct index cost of improvement, index cost of acquisition, and index cost of improvement. From the balance, we reduce the exemption under section 54 to 50H, if any, and consequently we get the amount of short-term capital gain or long-term capital gain, which is chargeable to tax. What is the meaning of full value of consideration? How do we determine this? So there are 3 cases which we need to note. Where the consideration is in money, then full value of consideration, or FVC, is equal to the value of money. In the case of exchange, FVC is what? It is the fair market value of asset which is received on the date of transfer. So fair market value on the date of transfer of the asset which is received. Where the consideration is not ascertainable or it cannot be determined, then FVC is equal to fair market value of the asset on the date of transfer. But of which asset? Not the asset received, but of the asset transferred. This is by virtue of section 50T. How do we determine cost of acquisition? It depends on where the capital asset became the property of the assessee on or after 1st April 2001 or before 1st April 2001. 1st April 2001 is the cutoff date for this purpose. Where the capital asset became the property of the assessee on or after 1st April 2001, then cost of acquisition is the actual cost of acquisition. But where it became the property before 1st April 2001, then cost of acquisition is what? It is the higher of cost of acquisition, or B, fair market value of the asset as on 1st April 2001. But in this case, if the capital asset is a land or building, the fair market value as on this date cannot exceed the stamp duty value as on this date, wherever it is available, right? So where the property is acquired before 1st April 2001, there is an option to take the fair market value as on 1st April 2001 as the cost of acquisition, where it is higher than the actual cost. Cost of improvement. What is the meaning of cost of improvement? It means expenditure, all expenditure of what? Of capital nature, not of revenue nature, which is incurred in making any additions or alterations to the capital asset by the assessee. But it does not include two items. One, expenditure which is incurred before 1st April 2001, it does not form part of COI. Okay. Second, expenditure which is deductible in computing income under any other head. That means either under the head IHP or PGBP or IFOS, it is not deductible as cost of improvement because it has already been deducted under a different head. Now, in the case of long-term capital gain, instead of COA and COI, we take indexed COA and COI, cost of acquisition and cost of improvement. And how do we compute this? Index cost of acquisition is cost of acquisition multiplied by cost inflation index or CII for the year in which asset is transferred, divided by what? CII for the first year in which the asset was held by the assessee, or 2001, 2002, whichever is later. So in effect, this means that if the asset is acquired before 1st April 2001 that we saw earlier while seeing the formula for computing cost of acquisition, then in that case, the cost inflation index can be taken for 2001, 2002. Else, the cost inflation index for the year in which the asset was acquired, or that means in the year or the first year in which the asset was held by the assessee, is to be taken. Index cost of improvement. Cost of improvement into CII for the year in which the asset is transferred, divided by CII for the year in which improvement to the asset took place. This 2001, 2002 is not relevant here because the expenditure incurred before 1st April 2001 is not included as part of cost of improvement. Now, cost inflation index for 2001-2, which is the base year, is 100, and for 2022-23, which is the current previous year, in our case, which is relevant to us, is 331. This is what you can remember. Now, benefit of indexation is not available in the following cases. So even if the gain is long-term capital gain, you should not provide for indexation. You should not index the cost. 1. Asset forming part of block of assets for purposes of depreciation. Section 50 applies for computing. We will look at this in some time. In debentures. 3. Bonds, except sovereign gold bonds or capital index bonds. Indexation is not available in the case of slump sale and in the case of computing long-term capital gain under section 112A. That is, in the case of equity shares or units of equity-oriented fund on which STT is paid, on which a concessional tax rate of 10% applies. Indexation is not available. What do we do where advance money is received? What are the tax implications? This covers a situation where the assessee was negotiating the transfer of a capital asset and he received any advance or other money on this account. But the negotiation did not result in the transfer of the capital asset, and therefore, in terms of the agreement, the assessee retained or forfeited some amount. Now, what is the tax treatment of such amount which is retained or forfeited? It depends on the date. Where the sum is retained or forfeited on or after 1st April 2014, then It is not taxable as capital gain, but the sum is taxable under the head IFOS. But where the sum is retained or forfeited before 1st April 2014, then capital gain becomes relevant. And in that case, the sum is not directly taxable as capital gain, but is indirectly taxable as capital gain. How? The sum is deducted in computing the cost of acquisition. Sum is deducted from what? Sum is deducted either from the cost for which the asset was acquired, where we pick up the cost of acquisition, or from the written down value, where we compute the capital gain under section 50 on account of depreciable assets forming part of block of assets, or from the fair market value. This is the case where we take FMV as on 1st April 2001 as the cost. So the sum is deducted from either of these cases in computing the cost of acquisition. Now, consequently, when is this sum brought to charge? This sum is then ultimately brought to charge when capital gains arise. And capital gains arise when the capital asset is eventually transferred. Not when the sum is retained or forfeited, but when the capital asset is eventually transferred. What we need to note is only the sum forfeited by the SSE is deducted under section 51. That means under section 51. The sum which is forfeited by the previous owner is not deducted. So where we are taking the cost of acquisition of the previous owner in computing capital gain, and the previous owner had forfeited such sum, it is not deducted. If the SSE had retained or forfeited the sum, it is deducted from cost of acquisition. So now we come to the concept of previous owner, and the relevant section which deals with this concept is section 49(1). In certain cases, the cost is determined with reference to the previous owner, not with reference to the SSE. And this covers 7 situations. 7 situations where the capital asset became the property of the SSE. So where the SSE acquires the capital asset either by way of distribution of assets on partition of a HUF, or by way of a gift, or will, or succession, inheritance, or devolution, or by way of transfer to an irrevocable trust, or transfer by a holding company to its wholly owned subsidiary, or vice versa, provided the transferee is an Indian company, or transfer in the case of amalgamation or demerger by the amalgamating or demerged company to the amalgamated or resulting company, provided the transferee is an Indian company. In such case, the previous owner is not liable to capital gain on the transfer of the capital asset to the SSE. But now when the SSE who is receiving the capital asset from the previous owner subsequently transfers the capital asset, capital gains arises in the hands of the SSE. And then how do we determine cost of acquisition? Cost of acquisition is the cost for which the previous owner acquired the property. The period of holding includes the period of holding of the previous owner. Consequently, indexation for computing cost of acquisition runs from the year of acquisition by the previous owner, and substitution of fair market value as on 1st April 2001 is also available. In effect, the computation is made with reference to the previous owner, not the SSE. What about cost of improvement? It includes cost of improvement incurred or borne not only by the SSE but also the previous owner. So what is meant by previous owner? Who is the previous owner? So previous owner means the last previous owner who acquired the capital asset by a mode other than that referred above. So A gives the capital asset to B gives the capital asset to C, and C gives the capital asset to D. Now when D transfers it, D will be taxable as capital gain, and A will be the last previous owner who acquired it by a mode other than that referred above. For example, if A purchased the capital asset, so A will become the previous owner in this case. Now there can be a situation where cost is not ascertainable for the previous owner. Then what do? Then we take the fair market value as the cost of acquisition of the previous owner. Fair market value on which date? On the date on which capital asset became his property of the previous owner. Special provisions apply in the case of depreciable assets, and the relevant section is section 50. So as we noted above, how do we compute capital gain? This is the basic formula. This is the basic formula that we noted for short-term capital gain and long-term capital gain. But there is a slight modification in this formula when the capital asset is an asset forming part of a block of assets in respect of which depreciation has been allowed. In such case, we need to follow 3 steps. Step 1. We first determine the written down value of the block of assets as on 31st March of the previous year. And this is what we calculate for the purpose of granting depreciation. We have referred this in the topic in PGBP. If you recollect, we first figure out the opening WDV for the previous year. We add the actual cost of assets acquired during the previous year, and we deduct the monies payable in respect of assets disposed of during the previous year, and this gives us the WDV for the purposes of depreciation. Next, in step 2, we determine whether depreciation is allowable or capital gains arise. Now, what we need to note is depreciation is allowable only where the block of assets exists and the WDV is not nil. So if the WDV is nil, depreciation cannot be allowed. If the block of assets also doesn't exist because all the assets have been disposed of, then also depreciation is not allowable. So where depreciation is allowable, we allow depreciation, capital gains does not arise. But where depreciation is not allowable, then capital gains arise, in which case the capital gain needs to be computed as follows as per step 3. So the formula that we looked above for computing capital gain is slightly modified. Full value of consideration less expenditure, this gives us the net consideration. This remains the same as per the normal method of computing capital gain. But then in the normal method, what we deduct further is the cost of acquisition and the cost of improvement. Now this gets modified. In this particular case, in that place, we deduct what? We deduct written down value of the block of assets as on 1st April of the previous year. That means the opening WDV of the previous year and the actual cost of assets falling within this block of assets which are acquired during the previous year. These two items is what we deduct, and then we arrive at the amount of capital gain, which is classified as short-term capital gain. So when we apply section 50, we need to note 3 things. 1. Option to substitute FMB on 1st April 2011 is not available. Indexation is not allowed. And capital gain is treated as short-term capital gain. Long-term capital gains does not arise in this case. Now, as we know, capital gain is taxable in the year of transfer of capital asset. But there are certain special provisions which create an exception. We will look at these exceptions. That is, capital gain is taxable other than in the year of transfer. Insurance compensation, section 45(1)(a). This covers a case where there is damage or destruction to a capital asset and the SSE receives insurance compensation. The damage or destruction is due to these 4 categories of specified events. 1. Flood, typhoon, hurricane, cyclone, earthquake or other convulsion of nature, or B or 2. Riot or civil disturbance, or 3. Accidental fire or explosion, or 4. Action by an enemy or action taken in combating an enemy, whether with or without a declaration of war. In these situations, if insurance compensation is received for damage or destruction of capital asset, then capital gain is computed as follows. So capital gain is taxable in the year in which insurance compensation is received, not in the year of transfer. What is the year of transfer in this case? The year of damage or destruction of capital asset. But capital gain gets taxable in the year in which insurance compensation is received. Full value of consideration is what? It is the amount of insurance compensation. It is the value of any money received from the insurance company, or if assets have been received, then the fair market value of those assets on the date of receipt. We deduct expenditure as far as cost of acquisition and cost of improvement is concerned. The period of holding. The period of holding, it runs till the date of what? Transfer of the capital asset, which is what? Damage or destruction. And as far as indexation is concerned, the year of transfer of capital asset is the year of damage or destruction. So period of holding and indexation is determined with reference to the year of transfer of capital asset, damage or destruction, but it is taxable in the year in which compensation is received. Now, where it is a case of the capital asset forming part of block of assets for depreciation purposes, we have noted that section 50 applies, and then short-term capital gain arises, and the computation is made accordingly. So the computation is made as we discussed some time back, and in this particular case, for the full value of consideration is what? The amount of insurance compensation. Rest of the things remain the same. Now, there can be situations of conversion of capital asset into stock and trade or vice versa. So we'll look at these provisions now. First, we look at conversion of capital asset into stock in trade, and the relevant section is 45(2). There are two events which occur. First, the owner of the capital asset, that is the SSE, converts the capital asset into stock in trade of a business carried on by him, or treats the capital asset as a stock in trade, right? So transfer arises on account of such conversion. So when does the transfer takes place? In the year in which the capital asset is converted or treated as a stock in trade. So year of conversion is the year of transfer. But capital gain is not taxable in the year of conversion. Rather, it is taxable in the year in which the stock in trade is ultimately sold or transferred. So the taxation is deferred. Now, when the stock in trade is sold or transferred, the capital gain is taxable. And how do we compute? Full value of consideration is taken to be the fair market value of the asset on the date of conversion. And for computing the cost of acquisition and cost of improvement, as far as period of holding is concerned, it runs till the date of conversion. It runs till the date of conversion, and indexation runs till the year of conversion. Why? Because this is the date of transfer. Conversion is the date of transfer. So the POH and the indexation run till the date or the year of conversion. So this is how we compute capital gain in event 1, that is on account of conversion. In event 2, the stock in trade will be ultimately be sold or will be transferred. In which case, what will happen? Since it is a stock in trade, business income will arise. And business income will be taxable when? In the previous year in which stock in trade is sold. So ultimately, both capital gain and business income become taxable when? In the previous year of sale. And when we compute business income, the full value of consideration is the actual consideration. And what is the cost in turn? The cost is the fair market value of the asset on the date of conversion. This is what is taken as the fair market value. So the full value of consideration taken for computing capital gain becomes the cost for computing the business income. So ultimately, capital gain and business income, they arise. And they are brought to charge to tax accordingly. Next, we look at a situation where there is conversion of inventory or stock in trade into capital asset. And this is something that we have already discussed while we were picking up the topic of PGBP. And here also two events occur. First, the inventory is converted into the capital asset, in which case business income arises. When is it taxable? It is taxable in the year of conversion. And what is the amount of business income? It is the fair market value of the inventory on what date? On the date of such conversion. Now in event 2, this inventory which is converted into capital asset, the capital asset then is transferred. It is transferred. So when will the capital gain be taxable? It will be taxable in the previous year of such transfer of capital asset. And for this purpose, how do we determine the cost of acquisition? So we take this FMV. We take this FMV that was taken as business income earlier, that becomes a cost of acquisition for the purpose of computing capital gain. And what about period of holding and the indexation? It runs from the date of conversion. So period of holding runs from the date of conversion because this becomes the date of acquisition of the capital asset. And consequently, indexation also runs from the year of conversion. And accordingly, we determine the amount of capital gain. Special provision is made under section 45(5) where there is compulsory acquisition of a capital asset. This provision covers two cases. One, basically where there is compulsory acquisition of a capital asset and therefore there is a transfer. This also covers a case where the consideration is determined or approved by the central government or RBI. So these two cases are covered. And how do we compute the amount of capital gain? Now there are two components. First is the initial compensation or consideration. This is what is determined or approved in the first instance. And the other component is the enhanced compensation or consideration. The compensation or consideration may be further enhanced by any court, tribunal or other authority, and that is called enhanced compensation. So first we look at the taxability of initial compensation. Now, when does the transfer take place? What is the previous year of transfer? It is the year of compulsory acquisition. But when is capital gains taxable? It is not taxable in the year of transfer. It is taxable in the year in which such initial compensation or consideration is first received. Maybe the whole of such amount or even a part. So whenever the whole or the part is first received, that becomes the year in which capital gain is transferred, although the transfer took place in the year of compulsory acquisition. Full value of consideration is the initial compensation that is received. Now, as far as period of holding and indexation is concerned, it is determined in the context of what? In the context of the transfer of capital asset, which is what? Which is compulsory acquisition. So period of holding runs till the date of compulsory acquisition. Similarly, indexation runs till the year of compulsory acquisition. Now, what about enhanced compensation, which is the second component? If an enhanced compensation is received, it is taxable in the year of receipt. In the year of receipt. And the full value of consideration becomes the amount of enhanced compensation. And what is the cost of acquisition and improvement? It is nil. Why it is nil? Because this has already been taken at the time of determining capital gain in the context of initial compensation. So now it becomes nil. So the entire enhanced compensation becomes taxable as capital gain. Now, what is the nature of capital gain in respect of enhanced compensation? So it is actually the same as that for initial compensation. So if this is LTCG, this is also LTCG. If this is STCG, this is also STCG. If litigation expenses have been incurred in this connection, then those can be deducted as expenditure incurred in connection with the transfer in computing capital gain. Now, sometimes the compensation is received pursuant to an interim order. Now, the court proceedings are going on and an interim order may be passed, and on account of which the compensation may be received, but taxation doesn't happen until the order attains finality. So, such amount which is received pursuant to an interim order is taxable only in the previous year in which the final order is made, not in the previous year in which interim order is made. What about interest? Interest may be also generally received on account of delayed receipt of compensation. The point to note is it is not taxable under the head capital gain, rather it is taxable under the head IFOS. But when? In the previous year in which it is received. So it is taxable on receipt basis, not on due basis. And it is received after giving a flat deduction of 50%. So no other expenses on account of earning of that interest is supposed to be deducted. There is a special provision made in case of transfer pursuant to a joint development agreement or JDA. This is section 45(5)(a). Now this covers a transfer made by an individual or HUF, any other person is not covered, of a capital asset in the form of land or building or both. So any other capital asset is not covered under a specified agreement. And what is a specified agreement? It is a registered agreement in which the owner, that means the individual or HUF, agrees to allow another person to develop a real estate project on such land or building. So this person will be, say, a real estate developer. So the owner, individual or HUF, allows the real estate developer to develop a real estate project on his land or building in consideration, which is what? In turn, the individual or HUF would get a share in the project, and the share would be in the form of what? Land, building in such project, or maybe cash as well. In such case, how do we compute capital gain? So two events will occur. The first event will be where the individual or HUF or the SSE transfers the land or building or both under the specified agreement to the real estate developer. Okay, and then the individual or HUF would get his consideration as share in the project. In event 2, the individual or HUF or the SSE will then transfer or sell his share in the project. So these will be the two events. So we pick up the first event first, where the SSE transfers the land or building under the specified agreement to the real estate developer for developing a real estate project. In which case, what is the previous year of transfer of capital asset? The previous year of transfer is the year in which possession is handed over to the developer. Why? Because as we noted at the beginning of this video, the definition of transfer includes allowing possession of an immovable property in part performance of a contract referred under section 53A of the Transfer of Property Act. This is covered here. So when the possession is handed, that becomes the year of transfer. But capital gain is not taxable in this year. It is deferred. Till when? Capital gain is taxable in the previous year in which certificate of completion for the project is issued by the competent authority. COC for either the whole of the project or even a part of the project. That is the year in which capital gain becomes taxable. Now, what will be the full value of consideration? Full value of consideration will be the value of the share which the individual HUF receives. And what is that value? Stamp duty value of the share, that is land or building. On what date? On the date of issue of COC. Plus cash, if any, that will be added. As far as period of holding and indexation is concerned, that will be determined in the context of the date of transfer of the capital asset, which is what? As we noted above, the date of handing over of the possession. So period of holding runs till the date of handing over of possession, and indexation till the year of handing over of possession to the developer, and accordingly we determine the amount of capital gain. Now subsequently, capital gain will again arise when such individual or HUF transfers or say sells his share in the project which he had received earlier. In that case, capital gain becomes taxable in the year of transfer. In the year of transfer, full value of consideration is the actual amount of consideration. But what is the cost? What is the cost that is taken? It is taken to be the full value of consideration taken earlier under section 45(5)(a). So what was taken as FVC earlier now becomes the cost, and accordingly capital gain is computed. We now look at certain special provisions to prevent tax avoidance. First, we look at section 50C. This is a special provision made to determine the full value of consideration for transfer of land or building. So it covers a situation where there is a transfer of land or building, not of any other capital asset. If the land or building is transferred not as a capital asset but say as a stock in trade, then PGBP applies, and the corresponding provision is 43CA, which we have already discussed in the topic of PGBP. But if it is a capital asset, then section 50C applies and capital gains is relevant. Now we determine the full value of consideration for computing capital gain under section 50C. For this purpose, we benchmark the stamp duty value against the actual consideration. If the SDV is greater than 110% of the consideration, then SDV is taken as the full value of consideration for computing capital gain. If it is not the case, then actual consideration is accepted as the full value of consideration. Now, where SDV is taken to be the full value of consideration, then sometimes the SSE may claim that, look, the SDV is even greater than the fair market value, which is not justified. So in such case, if the SSE has not disputed the SDV in any court or forum, etc., then in that case, the AO may refer the valuation of the property to the valuation officer. Now, the valuation officer will determine the value of the property. Now, where it is even more than the SDV, then a benefit is provided whereby the full value of consideration is restricted to such SDV. But where if the valuation by the valuation officer is not more than the SDV, then the valuation officer's valuation is accepted as the full value of consideration. So when SDV is taken, SDV refers to what? SDV is the SDV on the date of transfer, which is the date of registration. But there may be a date of agreement as well for the transfer. And the SDV on the date of agreement and SDV on the date of registration may not be the same. So if the SDV on the date of agreement is lower, then it will be beneficial for the SSE to pick up this SDV. So is this allowed? Yes, it is allowed, but there is a condition. So the provisions provide that SDV on the date of agreement may be taken instead of SDV on the date of registration if the consideration, the whole or even a part of it, is received by a specified mode on or before the date of agreement. If consideration or a part is received by a specified mode, then this SDV can be taken instead of this. What is the meaning of specified mode? It is the same as we have been discussing in the video in the context of various provisions under PGBP. So 50C applies for land or building, but there is another provision 50CA which applies in the case of unquoted shares. What is unquoted share? Unquoted share is a share which is not quoted on any recognized stock exchange. For example, share of a private limited company. In that case, if there is transfer, when we determine the full value of consideration, what we do is we benchmark the actual consideration with the fair market value on the date of transfer. If the consideration is less than the fair market value, then we take fair market value as the full value of consideration, else we accept the actual consideration. Right? So section 50CA does not apply to what? If there is a transfer of quoted share, that means a listed share, section 50CA doesn't apply. Or even if it is a transfer of unquoted securities but not being shares, 50CA doesn't apply. Because 50CA applies only to unquoted shares. Cutoff of period of holding for computing long-term capital gain for unquoted shares is what? It is 24 months. This is what we need to keep in mind. We will now look at the provisions governing financial assets. So first we look at bonus or right shares or securities. In case of original share, the cost of acquisition is the amount actually paid for acquiring the share. Substitution of FMV on 1st April 2001 is allowed, and period of holding is reckoned from the date of allotment, which is what? Which is the date when the assessee acquired the share. In the case of bonus shares, there is no cost paid, so cost of acquisition is nil, but still substitution of FMV on 1st April 2001 is available, and the period of holding runs from the date of allotment, which is what? Which is the date when the bonus shares were acquired. In the case of right shares, now the assessee first receives or acquires the rights entitlement from the company, and then using that rights entitlement, the right shares are subscribed by the assessee. Now where the right shares are subscribed by the assessee, what will be the cost? The cost will be the amount actually paid for acquiring the share, the right share. Substitution of FMV on 1st April 2001 is available, and period of holding runs from the date of allotment. Now in a situation where the assessee doesn't subscribe to the right shares using the rights entitlement, rather he renounces the rights entitlement in favor of some other person, that is, he sells those rights entitlement, then what will be the cost? The cost will be nil because nothing was paid by the assessee to the company, and therefore substitution of FMV on 1st April 2001 is not applicable. From when will the period of holding be computed? From the date of offer of such right by the company. What will be the treatment in the hands of the person who acquires the rights entitlement from the assessee? What will be the tax treatment in the hands of such person? So what is the amount that such person will pay for acquiring the right shares? First, he will pay the purchase price to the assessee for acquiring such rights entitlement, right? And then he will also pay the amount to the company for acquiring the right share. So both will need to be aggregated. That will become the cost of acquisition. Substitution of FMV on 1st April 2001 will be available, and the period of holding will run from the date of allotment. Preference shares. There may be a situation where the preference shares is, say, converted into equity shares. So this conversion is a transfer, but this transfer is exempt from capital gain. It is not treated as a transfer specifically under section 47. So this conversion is not liable to capital gain. Now what happens when these equity shares are subsequently sold or transferred? Capital gains will arise. Now what about cost of acquisition, period of holding, and indexation? These will be determined not with reference to equity shares but with reference to the original preference shares. What happens when there is buyback of shares or other specified securities by a company? Now there could be buyback of shares from a shareholder or buyback of other specified securities. In the case of buyback of shares, it could be either by a domestic company or by a foreign company. Where there is buyback of shares from a shareholder by a domestic company, the shareholder is exempt under section 1034A on account of income arising from such buyback. So who pays the tax? The company pays the tax. It is called buyback tax or additional income tax under section 115 QA. What is the amount of buyback tax? 20% of distributed income. We had 12% surcharge and 4% HEC on tax plus surcharge. What is distributed income? It is consideration that is paid by the company at the time of buyback of shares, minus what? Minus the amount that was received by the company when it issued such shares. In other cases, that means when there is buyback of shares from a shareholder by a foreign company or when there is buyback of other specified securities, the shareholder is not exempt. Consequently, the company is not liable to pay buyback tax. So capital gains becomes taxable in the hands of the shareholder under section 46A. And how is that computed? So full value of consideration received minus the cost of acquisition. When is it taxable? In the year of buyback. Is indexation available? Yes, indexation is available. Sometimes there are cases when the share capital, when the shares of a company undergo consolidation and division into shares of larger amount, when the shares are converted into the stock, when there is reconversion of any stock into shares, when the shares are subdivided into shares of smaller amount, or when one kind of shares are converted into another kind. Say preference shares are converted into equity shares, or say shares of rupees 10 are split into two shares of rupees 5 each. In such case, when these are sold, then the cost of acquisition is determined with reference to the original asset. What about employee stock option plan or ESOP? So two events occur. When the specified security or sweat equity share is allotted or transferred by the employer to the employee, what happens? Taxable perquisite arises. We have discussed this in the topic on salaries. What is the previous year in which taxable perquisite arise? In the year in which a specified security or set equity shares are allotted or transferred by the employer to the employee. And what is the value of taxable perquisite? It is the fair market value of such security or share on the date on which the option is exercised by the SSE. We reduce the amount which is actually paid by or recovered from the SSE. Subsequently, such specified security or set equity shares may be transferred, say sold by the SSE. In that case, capital gain arise. When is it taxable? In the year of transfer of such specified security or sweat equity share, right? For this purpose, what is the cost of acquisition and or index cost of acquisition? So what is the cost that is taken into account? It is the fair market value which has been taken into account while determining the value of taxable perquisite. That is now taken to be the cost. What about period of holding? It runs from the date of acquisition of the capital asset, which will be what? Which will be the date of allotment or transfer by the employer of the security or shares. Debentures. So as we know, debentures are securities. So what is the cutoff period holding for determining short-term or long-term capital gain? It is 12 months for listed debentures and 36 months for unlisted debentures. We also noted some time back that indexation is not available in the case of debentures. Now debentures of a company may be converted into shares of that company. Debentures are converted into shares. In such case, such conversion is a transfer, but it is not liable to capital gain. It is not treated as transfer by virtue of section 47. Now, what happens if these shares are subsequently sold? Capital gain arises. How do we compute the cost of acquisition, period of holding, and indexation? These are determined with reference to the original debentures. What about bonds? Bonds are also securities. Thus, the cutoff period holding for short-term or long-term capital gain is 12 months for listed bonds and 36 months for unlisted bonds. As we noted some time back, indexation is not available in the case of bonds, but it is available for sovereign gold bonds or capital index bonds. Now, just like debentures, bonds may be also converted into shares. In that case, such conversion is not liable to capital gain, but when such shares are subsequently sold, the cost of acquisition, period of holding and indexation are determined with reference to the original bonds. What we discussed above were the general provisions in respect of bonds. Now, special considerations for zero coupon bond apply. And what is that? We have already noted some time back that maturity or redemption of zero coupon bond is treated as transfer and therefore it is taxable as capital gain. And the cutoff period of holding for a zero coupon bond is 12 months. So if it is more than 12 months, long-term capital gain apply. There are special provisions in respect of intangible assets. And there are 8 kinds of capital assets which you can see here. Goodwill of a business, right to manufacture, produce or process any article or thing, right to carry on any business or profession, goodwill of a profession. So goodwill of a business is in 1 and goodwill of a profession is in 4. Trademark or brand name associated with a business or profession, tenancy rights, stage carriage permits and loom hours. And the acronym which you can use for quick learning is GRRTTSL. What is the cost of acquisition that we should take? If the asset was purchased, then it is the purchase price. It is the purchase price in all the cases. If it was acquired from the previous owner, then it will be the purchase price of the previous owner. But in any other case, that means if it is self-generated, then since there is no cost, the cost of acquisition will be nil. The cost of acquisition will be nil. As far as substitution of FMV on 1st April 2001 is concerned, it is not allowed. It is not allowed. As far as cost of improvement is concerned, it is also taken to be nil. But it is the actual cost of improvement in cases 4 to 8. That means for cases 1, 2 and 3, the cost of improvement is nil. Expenditure on transfer is taken as the actual expenditure. So for items 1 to 8, the provisions are the same except for cost of improvement, which is taken to be nil in the case of items 1, 2 and 3, while it is taken to be actual cost of improvement for items 4 to 8. What about any other intangible asset which is not listed above? In that case, we should note that capital gain is not chargeable if such capital asset, intangible asset is self-generated, because in that case, the cost of acquisition cannot be determined, so the computation provision fails. Now we turn to business reorganization and we look at amalgamation and demerger in brief. First, we look at the case of amalgamation. Now, there can be certain events which will take place. The first event will be where there is amalgamation, there will be transfer of a capital asset by the amalgamating company to the amalgamated company. So by the amalgamating company to the amalgamated company. Now this transfer is exempt from capital gain. Capital gain does not arise. Okay. When amalgamated company subsequently transfers the capital asset, then capital gain arises in the hands of the amalgamated company. And what about then cost of acquisition, period of holding and indexation? These are determined with reference to the previous owner, that is the amalgamating company. And accordingly, we determine the amount of capital gain. What about the shareholder? Shareholder will also face 2 events. The first event will be at the time of amalgamation, when there will be transfer by the shareholder of shares in amalgamating company against allotment of shares in amalgamated company. So the shareholder will get shares in the amalgamated company and he will transfer what? He will transfer the shares which he holds in the amalgamating company. So this transfer is not liable to capital gain. Capital gain doesn't arise. But what happens when the shareholder subsequently transfers or sells the shares in the amalgamated company? Then The cost of acquisition, period of holding, indexation is determined with reference to the shares that he held in the amalgamating company. And accordingly, we determine the amount of capital gain. But the point we need to note is these provisions apply when the amalgamated company is an Indian company. When the amalgamated company is an Indian company. Now we look at the case of a demerger. In the demerger, a company is demerged. In other words, visualize it as if the company is split into two parts, right? So the part that is split is the part that is demerged, and what is formed is the resulting company, right? So there is a demerged company and then there is a resulting company. So in the case of demerger, there is a transfer of capital asset by the demerged company to the resulting company, right? And this is not liable to capital gain. Capital gain doesn't arise. In this case, it is specifically exempt. What happens where the resulting company subsequently transfers the capital asset? Then capital gains arise, and cost of acquisition, period of holding, and indexation are determined with reference to the previous owner, that is the demerged company, and accordingly we compute capital gain. What about shareholders? Firstly, there will be a transfer or issue of shares by the resulting company to the shareholder of demerged company in consideration of demerger. So shareholder will be holding the shares in the demerged company. Pursuant to the demerger, the shareholder will receive or will be allotted shares in the resulting company. In such case, capital gain does not arise. What happens when the shareholder subsequently transfers the shares held in the resulting company? Then in that case, the cost of acquisition, period of holding, and indexation is determined with reference to share held in the demerged company. And what will be the cost of acquisition for shares held in the resulting company? So after demerger, so before demerger, the shareholder was holding shares in the demerged company. But after demerger, now shareholder will hold the shares both in demerged company as well as in the resulting company. So you can visualize that his holding in the demerged company is now split as in the demerged company and in the resulting company. So now the cost of acquisition in the resulting company will be computed proportionately. So we will pick up the cost of acquisition of shares in the demerged company, and then we will apply a ratio, which will be what? Which will be based on the net book value of assets transferred in a demerger divided by net worth of the demerged company immediately before the demerger. That will become the cost of acquisition. For these provisions to apply, the condition is that the resulting company should be an Indian company. We now look at the provisions of slump sale, and this is provided by section 50B. A slump sale is a transfer of one or more undertakings. So specific capital asset is not transferred, but it is a transfer of an undertaking. So therefore, it will include all the capital assets, right, forming part of that undertaking. So all of them will be transferred in lump sum. So that's why it is called as a slump sale. So slump sale means a transfer of one or more undertaking for a lump sum consideration. So values are not assigned to individual assets and liabilities. So there is a lump sum consideration and there is transfer of one or more undertakings. In that case, full value of consideration is fair market value of the capital asset as on what date? On the date of transfer. We deduct expenditure on transfer, and then we determine cost of acquisition and cost of improvement. It is the net worth of the undertaking or the division. This is deemed to be the cost of acquisition and improvement. Now we need to know that the cutoff period of holding for long-term capital gain is 36 months. But even if the capital gain is classified as long-term capital gain, even then indexation is not available while computing capital gain on slump sale. What is the meaning of net worth? Net worth of the undertaking or division is equal to aggregate value of total assets minus what? Value of liabilities as appearing where? In the books of account. How do we determine aggregate value of total assets? So there are 4 considerations involved. In the case of depreciable assets, we take the written down value of the block of assets computed under the Income Tax Act. In the case of self-generated goodwill of business or profession, the value we take is nil. In the case of a capital asset where whole of the expenditure is allowed as a deduction under section 35AD, we looked at this in the topic on PGBP, the value is taken to be nil. In case of all other assets, what we take is the book value of such assets. What if there is a change in the value of assets because there is a revaluation of the asset? That change in the value, either increase or reduction, we ignore. This is how we compute capital gain in the case of slump sale. Now moving on to certain other transfers which are not liable to capital gain under section 47. Work of art. Where the capital asset is a work of art, archaeological, scientific or art collection, book, manuscript, drawing, painting, photograph or print. And its transfer is to whom? To the government or university, national museum, national art gallery, national archives or any other notified public museum or institution. Then this transfer is not chargeable to capital gain. Next is the case of reverse mortgage. So reverse mortgage scheme, it applies to a senior citizen basically, right? We are not talking about specific details here, but it basically applies to a senior citizen and it covers what capital asset? A residential house property located in India. Now in the case of reverse mortgage, the transfer of a capital asset is not chargeable to capital gain. The individual would receive a loan in the transaction of reverse mortgage from the lender, say from a bank. It will be exempt under section 1043. We have noted this in the topic on exempt incomes. When does capital gain arise then? Capital gain only arises on the alienation of mortgage property by the mortgagee for recovering the loan. So if there is a default, then the bank needs to recover the amount of loan. For that, it will alienate or maybe transfer or sell the mortgage property, or in that event only capital gain arises. We will now look at the exemptions provided in computing capital gains. And there are 6 sections, 54 to 54F, and we will look at each of these sections now. And the presentation here, as you can see on your screen, is in the form of a table, so that makes comparative understanding quite easy. So first we look at section 54. Section 54 benefit is available to an individual or HUF, not to any other person. And exemption is available in respect of capital gain which arise on account of transfer of original asset. Transfer of original asset. What should be the original asset in the case of section 54? It should be a residential house. Income from such residential house should be chargeable under the head income from house property, and it should be a long-term capital asset. So short-term capital gain is not eligible for exemption under section 54. Now to claim exemption, the assessee should acquire a new asset. Should acquire a new asset. What should be that new asset? It should be one residential house in India. One residential house in India, right? In respect of this, exemption can be claimed under section 54. There is an exception. Exemption can be claimed in respect of acquisition of 2 houses also. But there is a condition. The condition is that the capital gain should not be more than rupees 2 crore. However, this option of claiming exemption in respect of 2 houses is a once in a lifetime option. Now the new asset should be purchased 1 year before the date of transfer of original asset or 2 years after, or constructed 3 years after the date of transfer of original asset. If that be the case, then exemption under section 54 is equal to lower of the amount of capital gain which arises on account of transfer of the original asset, or B, the cost of new asset. What is the cost of new asset? The cost of new asset is the amount which the assessee utilizes for acquiring the new asset, that means for purchase or construction, before furnishing of return of income, because when the return of income is to be furnished, the details are supposed to be mentioned in the return. So till that date, we need to determine certain things. So cost of new asset is what? either the amount utilized for new asset before furnishing of return of income, or the amount which is not so utilized can even be deposited in the capital gains account scheme before furnishing of return, but latest by the due date to furnish the return. That amount also becomes eligible for exemption. So both the amount utilized as well as the amount deposited in the scheme needs to be added up, and the capital gain exemption is lower of capital gain or the cost of new asset. So the capital gain account scheme applies in the case of section 54. There is a lock-in period in respect of new asset. So the new asset which is acquired should not be transferred within the lock-in period, and the lock-in period is 3 years. If the new asset is transferred within the lock-in period, then capital gain becomes taxable. The effect is that the exemption is forfeited. Exemption is forfeited, and for this, the cost of acquisition while computing capital gain is what? It is the cost of the new asset minus the capital gain exempted earlier. So in effect, the capital gain exempted earlier gets forfeited. This capital gain on transfer of new asset is taxable in the previous year in which the new asset is transferred. And the capital gain which so arises is long-term or short-term capital gain depending on the period of holding of the new asset. Now, as we noted above, amount can be deposited in the capital gain account scheme, and that amount needs to be utilized in purchase or construction of the new asset within the timelines which are given above. So as we saw, the outer timeline is 2 years for purchase or 3 years for construction. So basically the outer timeline is 3 years. So if the capital gain account scheme deposit is not utilized, whether wholly or partly, within this outer timeline time limit of 3 years, then the amount becomes taxable as capital gain. What amount is taxable? The amount which is not utilized to acquire the new asset within this outer time limit. When is this taxable? In the previous year in which this outer time limit of 3 years expires. And what is the nature of the capital gain which is taxable? It is the same as original capital gain. Because in section 54, the original capital gain will always be long-term capital gain. Here also, in the case of non-utilization of CGAS deposit, the capital gain that will be taxable will also be long-term capital gain. In such case, thereafter, the SSE can withdraw the unutilized amount and do whatever he wants to do with that amount. The second exemption provision is section 54B. Like section 54, it also applies to an individual or HUF. What is the original asset in respect of which the capital gain arises, which can be claimed as exemption under section 54B? Agricultural land. So agricultural land should be transferred by an individual or HUF. And what is the condition? The land was being used by SSE or his parent for what? For agricultural purposes. When? In the 2 years preceding the date of transfer, not the year of transfer, preceding the date of transfer. And such agricultural land can either be long-term or short-term capital asset. So either long-term or short-term capital gain can arise, and then exemption can be claimed under section 54B if the SSE purchases what? An agricultural land 2 years after the date of transfer of the original asset. So this is a rollover exemption like section 54. So in section 54, we transfer a residential house and then we need to purchase a residential house. In section 54B, we transfer agricultural land and then we need to purchase an agricultural land. So that is called a rollover exemption. Okay, now if this condition is satisfied, then exemption can be claimed, and the formula is the same as that for 54. Lower of amount of capital gain or the cost of new asset, and cost of new asset is what? The amount which is utilized for purchase of the new asset before furnishing of return, or the deposit in capital gain account scheme before furnishing of return, but latest by the due date to furnish return of income. So capital gain account scheme is also applicable like section 54. There is a lock-in period in terms of the new asset, which is 3 years, right? If the new asset, that is the agricultural land, is transferred within the lock-in period, then capital gain becomes taxable. and the formula is the same as that for section 54. Exemption is forfeited and the cost of acquisition will be equal to cost minus capital gain exempted earlier under 54B. It is taxable in the previous year in which the new asset is transferred, and long-term or short-term capital gain arises depending on the period of holding of the new asset. Similarly, CGAS deposit needs to be utilized within the outer time limit of 2 years. It is 2 years under section 54B. If it is not so, then similar implications arise as they arise for section 54. Amount not so utilized within this outer time limit is taxable as capital gain in the previous year in which this period expires, and the nature of capital gain is the same as that of the original capital gain, that is capital gain arising on transfer of the original asset. And after that, the unutilized amount can be withdrawn freely by the SSE. Now what we need to note is, if it is a case of rural agricultural land in India, we know that this is not a capital asset, and therefore if this capital asset is transferred, the transfer is not liable to capital gain, and therefore section 54B is not relevant, right? Even in the case of new asset, there is a lock-in period, but even if the new asset is transferred within the lock-in period, then also no capital gain arise if that new asset is a rural agricultural land in India. This is what we need to keep in mind. What about urban agricultural land? In a case covered by section 1037, transfer of urban agricultural land is also exempt, and therefore section 54B is not relevant in that case. But this exemption applies for an individual or HUF if 4 conditions are fulfilled. 1. The land is situated in any urban area. 2. It was used for agricultural purposes by such individual or HUF or his parent during 2 years immediately preceding the date of transfer. 3. The transfer is by way of compulsory acquisition, or where the consideration is determined or approved by the central government or the RBI. And 4. The compensation or consideration is received on or after 1st April 2004. If these 4 conditions are satisfied, even transfer of agricultural land, which is urban agricultural land, is exempt under section 1037. So 54B is not relevant in that case as well. The third exemption provision is section 54D. As against 54 and 54B, 54D applies to all SSEs. What should be transferred? What is the original asset? It is land or building. Land or building. What is the condition? There are 2 conditions. Land or building was used in the business of industrial undertaking. When? In the 2 years preceding the date of transfer, not the year of transfer. And number 2, transfer should be by way of compulsory acquisition. So when capital gain arises on account of compulsory acquisition of industrial land or building, then exemption can be claimed under section 54D. And the capital asset, that means which is compulsorily acquired, can be either long term or short term. Now the new asset that needs to be acquired for claiming exemption is land or building. For what? For the purpose of shifting or re-establishing the existing industrial unit or setting up another industrial unit. So it's also in the nature of a roll-over exemption. So land or building is acquired compulsorily, and then land or building needs to be reacquired in the form of the new asset to claim exemption. And this new asset needs to be acquired. How? It can be purchased or constructed after 3 years. After 3 years from what? From the date of compulsory acquisition? No. After the date of receipt of compensation. And why? This is on account of section 54H. And this is a general provision, not only applicable to 54D, but it is a general provision, which says that in case of compulsory acquisition of the original asset, the time period is reckoned from the date of receipt of compensation. So when we talk about section 54D, while the date of transfer is the date of compulsory acquisition, but the timeline for acquiring the new asset is from the date of receipt of compensation, not the date of compulsory acquisition. If this condition is satisfied, then exemption can be claimed under section 54D, and the formula remains the same as that under 54 and 54B. There is a lock-in period for new asset. It should not be transferred within 3 years. But if there is a default, then again capital gain becomes taxable. And the implications are the same as under 54 and 54B that we have already discussed. Capital gains account scheme is applicable in section 54D as well. And the amount deposited in this scheme needs to be utilized within the outer time limit of 3 years. And if this is not the case, then the amount not utilized becomes taxable in the same fashion as we discussed for section 54 and 54B. The fourth exemption is provided by section 54EC and it also applies to any SSE. The original asset that needs to be transferred is land or building. And as against 54D, there is no other restrictive condition in respect of the transfer of original assets. So land or building, if it is transferred, exemption is available, but the only requirement is that the original asset transferred should be long-term capital asset. So short-term capital gain is not available, is not eligible for exemption under 54EC. What needs to be purchased to claim 54EC? Bonds need to be purchased. Redeemable after 5 years, or long-term bonds issued by NHAI, RECL or any other notified bond. And the purchase needs to be 6 months after date of transfer of the original asset. If this condition is satisfied, then the amount of exemption from capital gain is equal to lower of the amount of capital gain or the cost of new asset. That means the amount of purchase of the bonds. But there is an upper cap of 50 lakh in terms of cost of new assets. So 54EC exemption cannot exceed the amount of 50 lakh. Capital gain account scheme is not applicable in case of 54EC. Now there is a lock-in period in terms of new asset. That means the bonds that have been purchased. And there is a higher lock-in period of 5 years. There is a higher lock-in period of 5 years, so the bond should not be transferred or sold within the period of 5 years. Now this also includes a case where the bonds are converted into money within the lock-in period. If a loan or advance has been taken on the security of the new asset, that is the bonds, then that is also deemed as conversion into money. On which date? On the date on which the loan or advance is taken, right? And therefore, there arises a default in such case also. So if the new asset is transferred, or that means it is either sold, transferred, or converted into money, or loan or advance is taken on the security of the bonds within 5 years, then what happens? Exemption is forfeited. Exemption is forfeited and capital gains becomes taxable, which is equal to what? Capital gain exempted earlier. This is taxable in the previous year in which the bonds are transferred. And this capital gain is taxable in all the cases as long-term capital gain, right? Capital gain account scheme CGAS is not applicable, so there are no implications in terms of non-utilization of the CGAS deposit amount. Now, in respect of the investment in bonds, the SSE may be eligible to claim deduction under section 80C as well, but double deduction cannot be availed. So 80C is not allowed for investment which has been taken into account for granting 54EC exemption. We now finally look at 54F, and this applies only in the case of an individual or HUF. What should be the original asset? It can be any asset but not a residential house, because in that case 54 applies. The condition is that the SSE should not own more than one residential house other than the new asset on the date of transfer. At the most, one residential house can be owned by the SSE on the date of transfer, not more than one. And this is not including the new asset. Why? Because as we will now see, the new asset can be purchased before 1 year from the date of transfer of original asset. So at the time of the transfer of the original asset, the SSE may already be owning the new asset. So that's why we are excluding the new asset here. So other than the new asset, the assessee should not own more than one residential house on the date of transfer. And the asset that is transferred, original asset, should be long-term capital asset. So short-term capital gain is not eligible for 54F exemption. For exemption, what needs to be purchased is one residential house in India. This is the new asset. And this can either be purchased 1 year before or 2 years after, or constructed 3 years after the date of transfer of original asset. If this condition is satisfied, then exemption can be claimed under section 54F, which is lower of either the amount of capital gain or proportionate capital gain. This is different from 54, 54B and 54D that we saw, right? So exemption is not to the extent of cost of new asset, but exemption is to the extent of proportionate capital gain, which is what? Capital gain into cost of new asset divided by the net consideration. Now, what is the cost of new asset? It is similar to what we determine for 54, 54B and 54D. Therefore, capital gain account scheme is applicable. There is a lock-in period in respect of the new asset. And what is the lock-in period? It is 3 years. 3 years is the lock-in period. And what happens if the new asset is transferred within this lock-in period? Two implications arise. One, capital gain arises on transfer of the new asset, which is computed as per the normal way, and it is taxable in the previous year in which the new asset is transferred. And whether it is long-term or short-term capital gain, it depends on the period of holding of the new asset. The second implication that arises is that the exemption granted under 54F is now forfeited. And how does that happen? Capital gain is equal to capital gain exempted earlier. So capital gain exempted earlier now becomes taxable. But we need to note that such capital gain which now becomes taxable is taxable as long-term capital gain. As long-term capital gain. Now here we need to note additional restrictions under section 54F. Additional restrictions. The assessee should not purchase within 2 years or construct within 3 years, the same timeline as for acquiring the new asset. Should not purchase within 2 years or should not construct within 3 years from the date of transfer of original asset. What? Any residential house other than the new asset, right? So above we noted this restrictive condition that the assessee should not own more than one residential house other than the new asset on the date of transfer, right? Additionally, the assessee should not purchase or construct any residential house other than the new asset. If this condition is violated, similar implications arise. What? As per number 2 here, the exemption is forfeited and the capital gain that was exempted earlier under 54F now becomes taxable. When? In the previous year in which the extra house is purchased or constructed, and it is taxable as long-term capital gain. It is taxable as long-term capital gain. What about non-utilization of CGAS deposit within the outer time limit of 3 years? Within the outer time limit of 3 years. Amount becomes taxable as capital gain. What amount? The excess exemption that was allowed earlier under 54F now becomes taxable. And it is taxable in the previous year in which this period, the outer time limit of 3 years expires. The nature is same as with the original capital gain, and after that the assessee is free to withdraw the unutilized amount. We now look at computation of tax on capital gain, and this depends on the category of capital asset. The capital asset can be equity share in a company or a unit of an equity oriented fund, or it can be any other capital asset. Where it is equity share in a company or a unit of an equity oriented fund, capital gain can either be short term or long term. In case of STCG, 111A section is applicable. In case of LTCG, 112A is applicable. For 111A to apply, the condition is transaction of sale should be chargeable to securities transaction tax or STT. For 112A, the condition is that STT has been paid on acquisition and transfer of share. In case of shares, it should be paid on acquisition and transfer. In case of unit, it can be paid only on transfer. Now this condition for shares that STT should have been paid on acquisition also is open to certain relaxations. So this condition of STT payment on acquisition of equity shares is not applicable in certain notified cases. For our purpose, a couple of cases that are relevant is where transaction of acquisition of equity share was entered before 1st October 2004. That is the date when the STT came into force, before that date. So obviously STT would not be payable. Or if it was on or after 1st October 2004, but it is not chargeable to STT, in that case also this condition doesn't apply. This condition doesn't apply where acquisition of equity share is through an issue of shares by the company, the direct issue by a company. For example, it can be a bonus issue or a right issue. In that case, STT would not be paid on acquisition. So in these cases, even if STT is not paid on acquisition but only on transfer, 112A still becomes applicable. Now when 11A applies, a concessional tax rate of 15% is applicable. If 112A applies, then a further concessional rate of 10% is applicable, and there is also a threshold of 1 lakh. So 10% is applicable on LTCG exceeding rupees 1 lakh. Indexation is not available in case of STCG, but in case of 112A, even if the gain is LTCG, indexation is still not applicable. Now we talk of any other capital asset. The gain can either be STCG or LTCG. In case of STCG, the gain is treated as a normal income. It is not taxable at a special rate, so regular rate of tax applies as per the slab rates. And obviously, since it is short-term capital gain, indexation is not available. As far as LTCG is concerned, the relevant section is section 112. And now under 112, long-term capital gain can be categorized into 3 parts. 1. Where the capital asset is unlisted securities or shares of what? Of a closely held company, not a widely held company. And it is in the case of a non-resident. So this is the case of unlisted securities or shares of a closely held company in the case of a non-resident. In that case, a concessional rate of 10% applies and indexation is not applicable. Second category is of listed securities, but other than a unit or a zero coupon bond, right? In that case, how do we compute capital gain? It is lower of A or B. It is 20% with indexation or 10% without indexation. So A or B, and then we find out lower of A or B, and that is the tax on capital gain under section 112. Now as far as indexation is concerned, we should note that as far as zero coupon bond is concerned, indexation is not applicable on a zero coupon bond. As far as any other capital asset is concerned, which is a long-term capital asset and therefore long-term capital gain arises falling under 112, then the rate of tax which is applicable is the rate of 20%, and in that case indexation is available. So indexation is available only in the case of this general rate of 20% for LTCG. In all other cases, 111A, 112A and the other cases of LTCG under 112 as well as short-term capital gain which is not under 111A, indexation is not available. Now there is this benefit of unexhausted basic exemption limit which is available, UBEL. Before we move to that, we need to note what is the treatment of STT, because as we said 111A, 112A, STT would have been paid. Can this be claimed or is this deductible in computing capital gain? No, it is not. STT is not deductible in computing capital gain. It is neither a part of cost of acquisition nor a part of expenditure incurred on transfer. What we also need to note that once we compute tax on capital gains, surcharge may become applicable, as we discussed in the topic on rates of tax. We need to recollect that surcharge on tax on capital gain cannot exceed the rate of 15%. In what cases? In the cases of tax under 111A, 112 or 112A. For an individual HUF, AOP, BOI or AJP. This is the limit of the rate of surcharge, 15%. Now we come to the benefit of UBEL, unexhausted basic exemption limit, which means that the basic exemption limit of 2.5 lakh or 3 lakh or 5 lakh is not fully exhausted. It remains unutilized. So this benefit is given only to an individual or HUF who is a resident. If this is not the case, then this benefit is not available. But if the individual or HUF is a resident, then what we do? We find out the normal income. Normal income means what? The total income excluding capital gain taxable at special rate. That means under section 111A, 112A and 112. Under section 111A, 112A and 112, we exclude that, and the balance total income is what? It is the total income taxable at normal rate. So that is what we call the normal income. If this normal income is lower than the basic exemption limit, this will result in an unexhausted basic exemption limit. Basic exemption limit minus normal income. This is what we deduct from the capital gain under section 111A, 112A and 112A. So we reduce the amount of capital gain by such unexhausted basic exemption limit, and we compute tax on such capital gain on this reduced amount. So this is how we provide benefit of unexhausted basic exemption limit. Now this capital gain may include 111A, 112A and 112 as well. So 111A is taxable at 15%, 112A at 10% and 112 at 20%. So how should we adjust the unexhausted basic exemption limit within these capital gains to compute the tax? So we are free to do that, and accordingly, in order to take maximum benefit, it is good to adjust the capital gain in the following order. So first against capital gain under 112, because it is taxable at 20%, the maximum rate, then 111A because it is 15%, the lower rate, and then 112A, it is 10%, the least of these rates. So in order of descending rate of tax. So this is benefit of unexhausted basic exemption limit. Deduction from gross total income. So we can claim only on short-term capital gain which is taxable at the regular rate. Deduction from gross total income under chapter VIA cannot be claimed in respect of all other capital gain. That means 111A, 112A and 112. What about rebate under section 87A on the tax computed on this capital gain? It is not available in the case of tax on LTCG under 112A, but it is available in all other cases. Of course, in the case of 112 LTCG, which is taxable in the case of non-resident, 87A is not applicable because 87A is available only to a resident. Now there is a special provision for computing cost of acquisition where we are talking about section 112A. That means equity shares or units of an equity oriented fund. If this capital asset has been acquired before 1st February 2018, then there is a special mechanism to compute cost of acquisition, which we then use in computing capital gain, which is taxable under 112A. So the cost of acquisition in such case will be the higher of the following. A is the actual cost of acquisition of the capital asset, the actual cost of acquisition of the capital asset, and substitution of fair market value on 1st April 2001 is allowed in this case. So higher of A or B. B is what? It is lower of A or B. Lower of A, fair market value of the capital asset on 31st of January 2018 or the full value of consideration on the transfer of such capital asset. So higher of A, the cost of acquisition, B, lower of FMB on 31st January 2018 or full value of consideration on the transfer. Once the cost of acquisition is determined, then we compute the capital gain and then the tax on long-term capital gain under section 112A, and as we noted above, under 112A indexation is not available. What if there is a case of bonus shares or right shares which were acquired before 1st February 2018, in that case also the cost of acquisition is determined as per this special provision. Now, how do we calculate the fair market value of this capital asset on 31st of January 2018? It depends on whether the capital asset is listed on any recognized stock exchange as on this date or it is not listed on this date. Where it is listed on 31st January 2018, then it depends on whether the asset was traded on the stock exchange on this date or it was not traded on this date. If it was traded on this date, then the fair market value is the highest price which is quoted on the recognized stock exchange on this date. If it was not traded on this date, then we take the highest price when in the immediately preceding date on which the asset was traded on the stock exchange. In the second scenario, where the capital asset is not listed as on 31st January 2018, then if it is a case of unit of an equity oriented fund, then we take the NAV of such unit as on 31st January 2018. But if it is a case of equity share which is not listed on 31st January 2018, and therefore it means it now has been subsequently listed. So therefore it is listed on the date of transfer. It was not listed on 31st January, but it is listed on the date of transfer. So in that case, what we do? Fair market value is equal to cost of acquisition multiplied by cost inflation index for 2017-18, which basically pertains to this date, which is the year pertaining to this day, 31st January 2018. So cost inflation index for 2017-18 divided by what? Cost inflation index for later of 2001-02, which is the base year for indexation, or the first year in which equity shares were held by the SSE. So this is how we determine fair market value, and accordingly we figure out the cost of acquisition as per these special provisions, and consequently we compute the capital gain. So this brings us to the close of the topic on capital gain.